What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we are talking hedge funds. More specifically, A, what are they? And B, this article came across my page at some point, and it's a hedge fund that has been replacing the analysts with AI and has been in the market. So if you're excited for today's video or just curious to know what Fridge Financials is going to be covering today, feel free to like the video down below, subscribe to the channel, and turn on your bell notifications for all future uploads as per usual. So we'll first dive into what a hedge fund is. Then we're going to be looking back at this article here about how it beats the market. And just for ha-has, there's also an article about a fake AI hedge fund manager, and it's not the same one as the previous one. I promise. I looked into it. So first of all, kind of just going into what a hedge fund is. Now, a hedge fund basically is a fund that is run by a lot of, top analysts and executives that are in the finance industry, and you basically give them your money to invest on your behalf and to get returns. Now, just like a financial advisor, but these guys pull in a lot of money, okay? So they have what's called the 2-1-20 rule, which is how their fees are paid. So you have to pay a 2% of assets under management fee just for them having money in that they're managing, which is AUM, is assets under management. Just for them holding a bunch of money, you got to pay a 2% fee on that. And then 20% is a standard performance or incentive fee of 20% of the profits made from the fund by or above a certain predefined benchmark. So you got to pay 20% on those profits and 2% for the assets under management they are holding. So a lot of hedge funds do this, and that's how they make their money, as you know, and it kind of walks into how it works. So again, the 2% management fee is paid to hedge fund managers regardless of the fund's performance. They could lose so much money in the year and not beat the market and be down or whatever. And if they have $1 billion of assets under management, they earn $20 million in just management fees, even if it does badly. So that's a killer return. They get 20 mil just like that, right? Amazing. The 20% performance fee is charged if the fund achieves a level of performance that exceeds a certain base threshold known as the hurdle rate. Kind of walks into all this kind of stuff here, shows you how it works. The 10 highest paid hedge fund managers collectively made $3.43 billion in 2023. These are the top 5 who made money in here. Note that Jim Simons sadly passed away in 2024, so he was one of the top hedge fund managers. Again, they're the ones that oversee everybody in this case. As you will know, Ken Griffin from Citadel, which was in the Robinhood scheme, not scheme, I don't want to say that, which was in the Robinhood fiasco and whatever happened in 2020 with GameStop saga and all that stuff like that. Ken Griffin, $2.6 billion is what his hedge fund income was in 2023. Steve Cohen, also a famous one. If you watch the Netflix, they made a video, or they made a movie or almost like a documentary about it. Point 72 also comes up in there, which is with Steve Cohen. He made $1.6 billion. Absolutely crazy. I will never see that much money in my life. Talk about if it's justified or not. And believe it or not, which is what the crazy thing is that it says Renaissance is best known for the tremendous returns generated by its flagship medallion fund, which is from Jim Simons, who's the one who was the manager of Renaissance. He has generated an average annual return of 40%. Those returns are after the 4% fee compared to 2% and performance fees of 44%. They are closed to outside investors since 1993. So you can't even get into it even if you want to. So they still return about 40%, and S&P 500 makes about 10%. So they're quadrupling their returns you would get in the average market index that you would invest your money into. It's crazy. Given the outsized returns Medallion has generated and how much it has been in the market, it can be claimed that the fees charged justify the returns provided to the investors, right? So again, they can charge higher fees and have them pay more in fees because they have a better return in the market. However, such stellar performance tends to be the exception, the exception rather than the norm in the hedge fund industry. While hedge funds, by definition, are expected to make money in any market because of their ability to go long and short, their performance has lagged equity indices for years. So imagine paying these fees and they're not even in the major equity indices. While for the trailing 5 years from 2017 to 2022, the top 50 hedge funds outperformed the S&P by 3%. It has been generally proven that hedge funds do not outperform the market. Hedge funds usually have a lot more of a leg up in the market because they have so much money that they're working with buying stocks and trading and everything else of that nature. They can really move stocks. These guys can move the prices very quick because they have so much money they can put into it and take out of it. So that's just something to keep in mind about, which is why you hear like market makers and everything else of that nature. Hedge funds are people that have so much money that they can move money in and out so quick. Walking through more, Warren Buffett. We can just invest into Berkshire Hathaway, which is a whole different thing. This is an example of 2 and 20, what it is, and the average returns. Can I invest in a hedge fund? Hedge funds are only available to accredited investors. Per the SEC, accredited investors are individuals that have an earned income over $200,000 annually, not Fridge Financials, in each of the prior 2 years, or a net worth over $1 million, not Fridge Financials, excluding the value of the primary residence, or hold in good standing a Series 7, Series 65, or Series 82 license. Not Fridge Financials. So the rich are the ones who can get into these hedge funds, and not us, unfortunately. Well, maybe one day. If I hit over $1 million in net worth, not with my real estate, my primary residence, I would just like to be into a hedge fund. Just say, hey guys, I have a hedge fund. Like, I have money in a hedge fund. How cool is that? But again, they kind of run similar to ETFs and mutual funds, it says here. And so that's kind of the idea as to how hedge funds works. Again, it's a lot of money being brought in from major investors who have a lot of money. They can move the markets pretty easily. They have fees and everything else, and kind of walks them through that. Let's talk this. Fake AI hedge fund manager admits fraud in the U.S. This came out February 13th, 2025. The operator for hedge fund that promised high returns powered by artificial intelligence, which has been the hype of the last however many years now, pled guilty to fraud in a New York court on Thursday. At a federal courthouse in Brooklyn, Mina Tadros pled guilty to investment advisor fraud in connection with his hedge fund, Tadros Capital LLC, which was falsely marketed as using AI-driven trading strategies to generate guaranteed annual returns of at least 30%. According to court filings, instead of using investor funds as promised, Tadros used their money to make Ponzi-like payments to new investors, to pay employees, and for other unapproved uses, defrauding investors of over $5 million. Nice. The only thing more artificial than Tadros' AI-driven hedge fund was his sincerity. He sold the dream to trusting investors instead of turning their money into a profit. He swindled it for his own luxuries, and he has been dealing with all of that. Fun times. Let's talk this one, though. This is the actual one that matters here. So, hedge fund startup that replaced analysts with AI beats the market. This article popped up on my news page, and I was like, I gotta read this. And this one came out February 14th. I don't know how I feel about how a fake AI hedge fund article comes out the 13th, and then this one with the new actual hedge fund AI came out the 14th. Coincidence? I really want to hope so, but obviously we shall see. So, a hedge fund startup that uses artificial intelligence to do work typically handled by analysts has outperformed the global stock market in its first 6 months while slashing research costs. Now, here's one thing to make a note of before we do anything else here, is that this is in the very early stages. 6 months. Okay? You need to have a lot of data to prove this is better. It's just like me with my Chat GPT picking trades. I'm up 30% in like 2 months, which is way higher than the S&P 500 and the NASDAQ and the Dow Jones. But I've only been doing it for 2 months. The real question is, what happens in a year from now, 2 years, 5 years? Is this still going to be doing a good job and beating the market? That's my only thing to keep in mind about very early stages here. The Sydney-based firm Minotaur Capital was founded by Armina Rosenberg and Thomas Rice. Rosenberg previously managed a global equities portfolio for tech billionaire Mike Cannon-Brookes and ran Australian small company research for JP Morgan Chase while she was 25. Rice is a former portfolio manager at Perpetual. All right, cool. The duo's bets on global stocks returned 13.7% in the 6 months ending in January versus 6.7% for the MSCI All Country World Index, which I'm guessing is the total world global stock market index, I'm guessing. Minotaur has no analysts on staff, while Rosenberg says AI models are far quicker and cheaper. Yeah, because again, you don't have to pay your analysts. Those analysts get paid a lot of money to work at these hedge funds, to do the research, to make the money. When they make a call out and they make a lot of money, they get a nice commission piece for it and stuff like that. You don't have to pay the AI commission because it's an artificial intelligence. It's robotic. It's technology. It's not a natural person, right? We're looking at about half the price in terms of cost of AI versus a junior analyst salary, Rosenberg 37 said on the first program. Mintar is among an increasing number of hedge funds experimenting with ways to improve returns and cut expenses with AI as the technology becomes increasingly sophisticated. Fridge Financials is doing it for free because I'm using a basic ChatGPT version and I'm up 30%. But again, not a hedge fund. Just keep that in mind. Still, the jury is still out on the ability of AI-driven models to deliver superior returns over the long run. Just like I said, again, it's a short-term return right now. You can't base it and predict it's going to kill the markets in the long term here. The Minotaur Global Opportunities Fund has a wide mandate scouring all globally listed equities. It charges only a 1.5% management fee. So a little bit less than the 2%, and still 20% performance fee on any profit. Rosenberg says she expects the fund to manage around 50 million in Australian dollars, which is 31 million US, by the end of 2025. Not too bad. Co-founder Rice was previously a portfolio manager of the Global Innovation Share Fund at Perpetual. He's also applied his own algorithmic amusement to making a Marvel movie recommendation site. So this guy is doing hedge fund AI trading by day and a Marvel movie recommendation algorithm by night. Wow. Makes me feel like I'm not doing it a lot in my free time besides making YouTube content videos, baby. All right, back to this now. The fund's large language models digest about 5,000 news articles daily. So it scours the internet, 5,000 news articles daily, and can churn out a roughly 2,000 word report on any given global stock that it deems has the potential to double in 3 years or improve tenfold in the subsequent decade. Whatever. Wow. Double in 3 years or improve tenfold in a decade. It's pretty impressive. The pair independently invested in the same home run in the past when they each rode Zoom's soaring share price after the outbreak of COVID-19, defying a market that was skeptical the video chat company could gain widespread adoption. And it did. It was over, I want to say $400 at one point. It was an absolutely insane return. Rosenberg interviewed Zoom salespeople to understand how swiftly corporate conversion was happening. Rice wrote a code to scrape the web for the number of Fortune 500 companies that had .Zoom footprints. Both discovered a strong take-up. So she went and talked to salespeople to see how it's doing during COVID. And then this person wrote a code to scour the Fortune 500 companies, the top companies in the world or in the country of the US at least, that had Zoom mentioned somewhere in their footprints. And I guess he probably saw a huge uptick in Zoom in the footprints, I'm guessing. And that's where it was wow, okay, let's take off and put some money into it. The blend of interactive interrogation, digital scraping persists. Makes sense. Mintar is bullish on Italian subsea cable manufacturer Prysmian after Rosenberg's work at Cannon Brook's office in the backing of a 24 billion transmission line between Singapore and a solar farm in Australia exposed her to how few such manufacturers exist and how bustling the business is. When manually added to their AI analysts, Prysmian came out top of the list. There's way too much information out there for people to deal with, so it's a funnel for companies undergoing a strategy change in order to tell us, hey, there's an inflection point here. Now you decide whether you think it's worth looking into or not. That's crazy. And this is, again, how it's been the fear, I guess, is imagine that you go into finance, you go in, you do internships at Goldman Sachs, JP Morgan Chase, whatever. You want to go work for a hedge fund, you want to have your own hedge fund, whatever. And they're all just we don't need you. We have AI. And there was one thing I watched. I watched a video from Meet Kevin earlier today who was talking about the AIs, and the jobs and stuff like that. And he made a very interesting point that I wanted to also think. Now that we're talking about this, I wanted to bring up. If we end up going down the line in the next year or so into a recessionary period because jobs start to decline, we have huge job layoffs and stuff like that of whatever the case is. He says that his worry is going to be who knows how long we might stay in this kind of period where there's a high amount of people not working. Because when people start to lay off, like Google lays off, Amazon lays off, and they start to experiment more with AI and integrate it more into their companies, there's not going to be a rush. And it might be even harder to start to hire people that are not AI if they start to run more AI driven based programs and they start to see how much production they can get and they can cut their costs back. If the job market comes down and there's a lot of people that are not working, it might be hard to get that started back up again if AI really takes over. Again, this AI is taking over a hedge fund managing millions of dollars and outperforming the global market. These people made 13% in 6 months compared to 6% from the major indices, and it's just them two. Nobody working for them, no interns, no one running them coffee, no one doing research analysts, nothing at all. And if companies start to adapt that more, which I feel like they're definitely already in the works of doing it, if companies start to adapt that more and push AI farther to learning and to being better and to being more productive, this is kind of starting to be like a little bit of like well, why do I need to hire person A when I can just buy this program and it's going to offset my costs long term? So that was kind of like, I was watching that video from Meet Kevin and he talked about that. And I thought it was very interesting. It was a very valid point as saying, if we start to go into a recessionary period and we have a lot of layoffs, you might have a little bit of a longer time period before you see jobs start to uptick again, because maybe AI's had given them more freedom to not have to go back and hire people. Who knows, right? So just something to consider about, something to think about, but a very interesting article here. Again, the point of me as the Fridge Financials and bringing the information here is to just educate what's going on in the financial markets. If you have no idea what a hedge fund is, you learned about what a hedge fund does and how they work and how they operate and how you get into a hedge fund. But now you have AI taking over potentially hedge funds. That is something that's really interesting, and I'll be curious to see how it does in the long term. For my sake, I would hope that it does worse than the regular indice does, so that way AI still stays below us. But only time will tell. Thank you so much for watching today's video. If you made this far in the video, obviously feel free to like the video, subscribe to the channel, turn on the bell notifications again for all future uploads. I hope you guys are making money in the markets, whether you're using AI like I do, you're a hedge fund AI like they are, or you're just an awesome person. Enjoy making the money in the market, guys. And as always, I will see you in the next video.